Welcome, everyone, to our capital markets update. My name is Kara Duckworth. I'm the Managing Director of Client Experience at Mercer Advisors, and I'm delighted to be joined as well by Don Calcagni, our Chief Investment Officer today. We have a lot to get to today, but it's important for us to tell you as we begin that all of the information that we are presenting today is for information only, and it should be general in nature. None of the information that we are presenting today should be construed as personal investment advice or personal financial planning related to your own situation. Those questions should be directed to your personal wealth advisor at Mercer Advisors. We have so much information to get to today, but Dawn, as we were preparing for this, and then last night as I was watching television, I thought of you as being a Philadelphia area native, and seeing the Phillies last night not make it to the World Series. So I thought you may not be having a good morning today, but I know that was on your mind last night.
You had to bring it up, right? You had to rub it in. So for sure, yeah, I was up late and hollering at the TV quite a bit. So yeah, it's interesting. Yeah. So on the one hand, I'm very disappointed in my Phillies. On the other hand, and our audience probably does not know this. This would only for people who are like economics nerds would know this. But there's a theory, a really bad theory that I think is wrong, that argues that when the Phillies win the World Series, that we have an economic recession. And that is so discredited if you just look at the data. But on the plus side, if indeed there's any credence to that theory, and I got to admit, I'm at least a little bit superstitious. On the plus side, it tells me that we're probably not going to have a recession. And I know many of our audience members had that question. It was probably the most popular question. And so rest assured, we probably won't have a recession now that my Phillies lost and will not be going to the World Series. So.
Good to know. That's how we're making decisions.
Just so people know, that's not how we make decisions. Right? Let's make sure there's no confusion.
Well, thank you all for submitting your questions. I know that we took a bunch of questions in advance of this presentation, and we're going to continue to be taking questions live as well. So if you have questions, please go ahead and submit them to the Q&A function that you'll see on the bottom of your screen so that we can review. But to start off, Don, we analyzed all of the questions that came in advance, and perhaps you can kind of talk about the trends that you're seeing and your comments there.
For sure. And so thank you, everybody, again, for submitting your questions. We love it when you do that, by the way. It gives us some insight into what's on your mind. And if you can see the slide here on the screen, this is a word cloud. So all we did is we took all of your questions, dropped them into a Google word cloud generator. And what this does is this highlights, what's on people's minds, right? Interest rates, right? Recession, bonds, things like that. No surprises here. These are topics that are on the minds of all of the members of our investment committee, on the minds of our advisors, and certainly we'll talk about these today. But again, no surprises that these are the major themes that seem to be rising to the top when we look at questions that you all submitted, plus also what we're hearing from our advisors as well. So let's jump right in. Karen, I'm going to kick it off here with about 10 to 15 minutes of prepared remarks, and then let's just get into everybody's questions. This is their time, and let's make sure they can get as much value out of our time together. So just a few high-level data points that I think we should touch on is, inflation, right? We're going to talk a little bit more about inflation here in a moment, but inflation has been driving what has been happening in the economy for the better part of 2 years. In March of 2022, the Fed began raising interest rates quite aggressively. We'll talk about interest rates some more here in a little bit. Unemployment still remains at near historic lows. And then GDP growth. In fact, just this morning, we received a new GDP report for the third quarter of this year. And it actually came in at a piping hot 4.5% GDP growth. This is the highest GDP growth in 2 years. So the US economy, by any objective measure, continues to grow. And again, we'll talk some more about that here in a few moments. data point here that's a little bit ironic is the consumer sentiment, how all of us are feeling about the economy. The University of Michigan does a survey to try to gauge how we're all feeling about our finances and the economy. That is still below average, below its long-term average, yet it is consumer spending that is really propelling US economic growth at the moment. So a bit of a contradiction there in the data. By the way, this is not new in economics. It's always really tough to try to figure out what the heck is happening in the economy because the data often gives us very conflicting messages. Just a couple of other high-level themes that we'll touch on today is, the Federal Reserve, of course, has raised interest rates quite dramatically over the past 18 months. There's this question around, are they going to continue to raise rates? We'll talk a little bit more about that here in a few moments. Whether or not the Fed raises interest rates, what we have observed here in the past month and a half is we have seen the 30-year mortgage rate hit a more recent all-time high, not an all-time high, but 8%, very high, probably the highest since about 2002 or 3. So very, very high. We've also seen the 30-year Treasury interest rate go up quite dramatically. It's now at just about 5%. I want to highlight what's happening over here. The Federal Reserve, this is the nation's central bank. They have been reducing their balance sheet. So what does that mean? To combat the global financial crisis back in 08, 09, and then to support the economy for the past decade, and then again during COVID, the central bank pumped a lot of cash, new cash, into the economy, and they do that by buying bonds, treasury bonds. Well, those bonds have been maturing, and as they mature, the Fed has been removing cash from the financial system. So that's also pushing up interest rates. So those are just a couple of themes. The rest here, we can perhaps save for another webinar. But what I want to highlight here is how dramatically inflation has come down. We're not there yet. Let's be very clear. We are not there yet. But inflation peaked at 9.1% in June of 22. The Fed began raising interest rates in March of 22. And since then, it has been pretty much an obvious trend down. Now, it is kind of flatlined a little bit. It's leveled out, right? The easier declines were the ones up in here. The Fed has a 2% inflation target. So even at a 3.7% current inflation rate, it's too high, right? And the Fed continues to highlight this. This is one of the reasons why the Fed might raise interest rates again, maybe another quarter point, maybe another 2 quarter-point hikes in the future. And again, we can tackle that. What I want to highlight before I leave this slide is that we are seeing some deflation, right? So inflation is when prices are going up. Disinflation is when the growth in prices is declining. Deflation is when prices are declining. So in energy, we have seen a decline in energy prices. This is, by the way, is not what anybody has really expected, given the war in Ukraine, now given the war in the Middle East. So again, just an interesting contradiction again in the economic data, I think relative to what we would have expected. So let's talk interest rates. Just to remind ourselves, the Fed raised interest rates quite dramatically beginning in March of 22. And just recently, I think it was July, it was their most recent rate hike. The Fed did not hike rates in September. And there's a debate around whether or not the Fed will raise interest rates again at the meeting in November. At the moment, the market does not think the Fed is going to raise interest rates in November. I tend to agree with that. But I do think that there is a chance that the Fed raises interest rates sometime in early 2024. I want to highlight the future here. These dotted lines represent what the market thinks the Fed is going to do over the next couple of years. And the market is this raspberry colored line. And then this sort of baby blue colored line is what the Fed, the central bank themselves, predicts the future path of interest rates will look like. And you can see that they mostly both align in that we think they're going to go down sometime in 2024. I would just caution, there is no law of finance, no law of economics that would lead us to conclude that interest rates should absolutely go back down. And in fact, given that the economy is doing so well, I think the Fed would be hard pressed to justify future interest rate cuts. I'm not saying that it won't happen. I'm just cautioning that some of these predictions, I think, are ultimately flawed and should always be interpreted with a very healthy degree of humility. All right, so be careful not to put too much stock in these interest rate predictions. One of the questions that we were seeing a lot in the questions that you all submitted was questions around, gee, why are interest rates rising? The Fed didn't raise rates in September. Why is it that the mortgage interest rates continued to go up? Why did the interest rate on the 30-year Treasury bond continue to go up? Well, there's a lot of reasons. I think one of the biggest reasons is that the federal government continues to borrow a significant amount of capital from financial markets. Like I said a few moments ago, the Federal Reserve is reducing its balance sheet. What that means is they are no longer buying bonds issued by the US Treasury, right? The US Federal Reserve is the largest buyer of bonds, or at least they were historically. They are no longer buying bonds. So what that means is they're not financing this $1.4 trillion in deficit spending. And in fact, that number came in at 1.7. So this was a projection from the Congressional Budget Office that was off a little bit. It actually came in at 1.7 trillion, very significant government deficit. The US Treasury is financing that now through borrowings from private investors in the marketplace. That pushes up interest rates because there's only so much capital available to be lent out at any particular time. So that's one of the reasons why I think rates have gone up. I think there's other reasons. I think we have political paralysis, obviously, in the House of Representatives at the moment. So there's these other issues, the prospect of a government shutdown, federal government shutdown. I know that was punted from late September to mid-November. And I think given the paralysis in Congress at the moment, I think it's going to be really challenging. It'll be interesting to see. I'm not a political scientist, full disclosure. I'm not predicting what Congress is going to do. But I do think that weighs on markets. Interest rates are high. The Fed has told us that they're going to be higher for longer. And I think all these reasons taken together continue to push interest rates higher, including interest rates on mortgages. So last slide here, Kara, that I'll review, and then we can perhaps open it up for some questions. What I want to draw your attention to is really just, how markets have done both in Q3, but also year to date. Markets, and by markets, I mean everything. I mean bonds, I mean international stocks, the whole 9 yards, actually peaked at the end of July. Since July, markets have come down a bit. We've seen a sell-off. That's partly in response to the fact that interest rates were going up. So as rates were rising, we started to see this sell-off in equity markets around the world, as well as bond markets. When interest rates go up, bond prices come down. And we see that represented here in these year-to-date returns. We see these slightly negative returns for US taxable and municipal bonds. We can talk some more about that here. I'm sure we have some questions, Kara, about some of that. But US equities continue to steal the show. This isn't always the case. Earlier this year, non-US equities were doing very, very well relative to US equities, but that has since reversed. But equities, for the most part, are positive around the world. Emerging markets coming in at third place there, but still positive through the end of September. So this is a year where we saw a bit of a recovery in stock prices relative to returns that we experienced last year, but we're still waiting to see bond prices really recover. And I think they will. Investors are going to recapture those losses in the form now of higher interest rates, higher yields. These are some of the highest interest rates that we've seen in 15 years. And, I'm sure we got many questions in the queue coming in from clients like, gee, why should I not put more money in bonds or CDs or something along those lines? And so happy to talk about that. So, Carol, I'll stop it here and we'll open up for some questions.
So as I'm reading through all these questions that are being submitted, Don, lots of them, thank you all for participating. The one that I'm seeing just rising to the top here is certainly about recession. Seems that the predictions are that the US is either already in a recession or is heading into a recession. Can you comment on that, if you think we either are or heading towards that?
Well, I think as we saw from this morning's GDP report, by any measure, the US economy is not in a recession. A recession is defined as generally, this is a sort of a rule of thumb definition, but it's defined as 2 successive quarters in a row of negative GDP growth. Well, GDP growth is, it's not negative, it is positive. It just came in at 4.5% for the third quarter. So again, not currently in a recession. If we go back to some of the data that I highlighted with my opening remarks, we have historically low unemployment. Inflation has come down dramatically, but still running pretty high relative to the Fed's target. But again, by any measure, the US economy is not in recession. And I think this is an interesting and humbling lesson that we all have to learn, especially those of us that work on Wall Street or work in economics or finance. And that is, this recession has been by far the most widely predicted recession. Like, there has been basically total consensus across Wall Street, across economists, that we were heading into recession by the fourth quarter of 2023. And it seemed very logical. It was a very strong case. Interest rates had gone up dramatically. It seemed obvious that the US consumer was going to pull back and not spend, given that prices were rising, given that interest rates were going up. I mean, perfectly logical case that we're heading into recession. And yet here we are, 4.5% highest GDP growth in 2 years. And so whether or not we're going into recession is debatable. I find it hard to believe that the economy won't slow down when you have mortgage rates at 8%. It just seems logical that consumers should pull back given higher interest rates and higher prices. We have not seen that. We have not seen that yet. In fact, if you look at the details of the GDP report that came out this morning, it is consumer spending that continues to drive the US economy higher. So at the moment, we're not in recession. Whether we go into recession is really hard to say. If we do, it probably won't be till the second half of next year, just because the US consumer appears at the moment to be so unbelievably strong. It just seems unlikely that we would go from 4.5% positive GDP growth to something that's negative overnight. That just does not seem like it's possible.
So Don, we're also getting a lot of questions related to interest rates. I know you commented on what you kind of thought the action of the Fed might be going forward or into the end of next year. So if you're maybe comment a little bit on what you think actually is going to happen with rates in the period of time. But I'm also seeing a lot of questions about mortgages. And do we think that those are going to be correlated to Fed interest rates? When do you think those might be going back down? Whether you're looking to buy a home or you're thinking about selling your home but don't want to have to refinance. I know that mortgages in relation to the interest rates are a big topic of interest.
Sure. And what I would say, let me tackle the second half of that question first. Mortgage interest rates absolutely are related to short-term interest rates that are set by the Federal Reserve. So they're absolutely related, right? It's not a law of physics, but they are definitely related. As the Fed raises interest rates, it's logical that mortgage interest rates would continue to rise. So the question then is, well, do we think the Fed is going to sit tight, or do we think the Fed's going to continue to raise rates or perhaps even cut interest rates? That's the debate. I personally think the Fed raises rates one more time, probably in early 2024. And the reason I say that is 3.7% inflation is still much higher than their 2% target. That's number one. And number two, the US economy is clearly still firing on all cylinders. That's not to say that there probably aren't, there certainly are some troubling, painful areas in the economy. I'm thinking of these young families that are trying to buy homes at the moment, but there's not a lot of supply on the market. So ironically, home prices have remained elevated despite 30-year mortgage rates now topping 8%. But a lot of that comes back to the fact that there's just not a lot of supply of housing on the market. You have a lot of families, a lot of homeowners who I think would like to move, but if you're locked in at a 3.5% mortgage, I think that's a barrier for a lot of those families to seriously contemplate putting their home on the market and perhaps moving, maybe downsizing or moving from, up north to somewhere down south, a warmer climate. So I think we're starting to see that's the problem in the housing market. There's just not a lot of supply. And a lot of this has been a problem that's been in the works for 10 or 15 years coming out of the global financial crisis. We had too much housing during the first decade of this century. Now we have too little. But I do think the Fed raises interest rates one more time, given the economy. I do think that's going to probably continue to push mortgage rates a little bit higher for a period of time. Like I said, there's really no law of physics that says the Fed has to reduce interest rates. We could be in this new interest rate regime for quite a long time. And so it could be a number of years, 1, 2, 3 years before we see interest rates come back. The Fed themselves is forecasting that they would be cutting interest rates, or that they expect themselves to be cutting interest rates in the second half of next year. But let's be candid. The Fed has the best economic data in the country. And even the Fed has a horrible track record of predicting what the economy is going to do, what markets are going to do, and what interest rates are going to do. So again, I would interpret all of this with a high degree of humility.
I want to shift our focus now, Don. Not quite so much on the US domestic, but maybe around the world. So we've got wars in Ukraine, we've got wars in the Middle East, we've got tensions with China and Russia. What do you think investors should make of all of the situation going on around the world, the geopolitical risk? Should they be concerned about that? And your view on investing in non-US markets?
Yeah, I think first and foremost, we should acknowledge the human dimension, right? Wars are, in my view, they are always a tragedy. Nobody wins. And, wars are the opposite of economic productivity, right? Wars destroy productive assets. They destroy lives. And so I think by any measure, it's a real tragedy what's happened in Ukraine, what's happening in the Middle East at the moment. Now, when I look at geopolitical risk through the lens of an investor's eyes, I think there's a couple things we need to keep in mind. Number one is that the purpose of markets, what markets do, markets are these giant scales that are always weighing information and incorporating that information into asset prices. That could be stock prices, bond prices, real estate prices, commercial real estate prices, even gold and Bitcoin, I would argue, are not immune to all of this information that markets are trying very hard to incorporate into prices. Geopolitical risk is certainly one of those factors that markets are always trying to incorporate into prices. So markets are not blind to what's happening in Eastern Europe or the Middle East or the tensions across the Taiwan Strait. But markets are incorporating more than that information, right? They're incorporating everything from interest rates, what the Fed is going to do. Markets are incorporating this 4.5% GDP report that we got this morning. They incorporate earnings reports from Alphabet and Microsoft and all of these other companies. So I think we need to be careful thinking that somehow that there's one piece of information that by itself will move markets dramatically. I would argue that there's lots of things that move markets. So how should we think about it as investors? I think markets are very resilient. If we look at geopolitical risk, we've had geopolitical risk since the dawn of humanity, right? For those of us that grew up during the Cold War, geopolitical risk was always ever present, right? During the Cuban Missile Crisis, right? Markets actually were very resilient, right? You would have thought that given the severity of that crisis, that markets would have absolutely cratered. Well, they didn't, right? And we've had many geopolitical crises since. We've also had other crises. We had the COVID crisis, right? March of 2020, April of 2020. Again, I think markets are pretty resilient. They incorporate this information. I hope, I pray that those wars come to an end as soon as possible. But the reality is geopolitical risk is a permanent characteristic of the human condition, and markets, I think, know that. Now, the second part of your question is, what do we think of international markets? Well, I think when we look at global markets, when you look at global stocks, for example, they are trading at very, very attractive prices relative to their profits, right? So a true investor looks at these things. They look at earnings, they look at profits. Forget the short-term trading, the momentum, all of that, right? That's speculation. That's not investing. But when you look at global companies, European companies, for example, are trading at 12 times earnings. Just to give you some context, US growth stocks, our technology companies, are trading at nosebleed valuations, 25, 26, 30 times earnings. We have some AI related companies that are trading at 50, 60, sometimes almost 100 times earnings. So I think when you look at stocks on a global basis, non-US stocks look pretty attractive. We haven't seen really great returns in non-US stocks in quite some time. But again, I think when you look at those prices, I think the forward-looking opportunity for those looks pretty attractive at the moment, certainly relative to the forward-looking returns for certain types of US companies.
You mentioned a lot of the things of how efficient markets are about absorbing information and taking in all of these details. But in contrast, if we look at the news and the headlines and we see political paralysis in Congress and we see high interest rates and high inflation and wars and economic problems in China, and we've got a challenging real estate market, and just seems to go on. And as an investor, you're kind of thinking, oh my goodness, these headlines are just, wow, so terrible. And we've got a couple of questions here. Is this reminiscent of what we saw in 2007 leading up to the global financial crisis? What do you think about, is a market crash coming?
Yeah, I mean, that's
put you on the spot there.
That's a very heavy question. So if you think about what a market a market crash is, it is when there is a substantial, dramatic decline in prices across all asset classes, right, around the world. And look, we've experienced that, right? 07, 08, the morning after Lehman Brothers filed for bankruptcy. So Lehman filed for bankruptcy on September 15th, 2008. That was a tough day for those of us that were in markets at the time.
Was.
And we were there. So I think history rhymes. I don't think history repeats itself perfectly. But again, first off, it's important to highlight that the only news that sells is bad news, right? Good news does not sell, right? And I think one of the privileges I have in my role is I evaluate all kinds of news. I probably read 3 or 4 newspapers every morning, podcasts. I sit in as a number of conference calls. And look, there is good news out there. And I know it's hard to see. And that's never going to make the front page of the newspapers, right? And it's certainly not going to make the evening news or a CNBC Fast Money episode. But there is good news in markets. Earnings look really good. These higher interest rates are good for many of our clients who are on the cusp of retirement, right? I think higher interest rates are a good thing for those of us that have diversified portfolios that don't want to just load up on portfolios that are, overweight global stocks. So I think there is good news out there. It's hard to see. I don't want to gloss over the fact that, look, there is bad news out there. But having done this now for close to 30 years, I can tell you there's always bad news, right? Even back in the 90s, during the dot-com bubble, there was bad news, right? For those of us that were around long enough, Russia defaulted on the ruble in September of, I think it was September 98, right? And the whole world went into cardiac arrest. Now the Fed rescued us at the time. But there's always bad news, right? Whether it be terror attacks, wars, unfortunately, seem to be a permanent condition for humanity, right? We had, after 9/11, we had the invasion of Afghanistan and Iraq and so on and so forth. So there's always bad news. The purpose of markets is to incorporate that news into prices, right? Because when there's lots of bad news, prices logically should go down. And prices go down because we now have to reward investors with a higher future return for assuming these risks, right? So again, markets are incorporating this information. You mentioned political paralysis in Washington. I think that is a big risk, right? I know we punted the prospect of a government shutdown from September to November. So it'll be interesting to see what happens in the House. Do they get a speaker? If so, who can that person, mend fences and build bridges to hopefully get a deal to fund government come November? But I think all of these things weigh on markets. I think without these things, markets would probably be a lot higher than they are today. But I don't see a crash coming in the traditional sense. And one last thing that I'll finish on, Kara, is that I do expect that there's a reckoning coming for certain types of US stocks. I mentioned those growth stocks, some of those technology stocks that are trading at nosebleed prices relative to their earnings. It does not logically make sense that they should be trading at those prices, given that interest rates have gone up so dramatically. I know many of our own clients submitted questions along the lines of like, gee, why not just own more bonds with interest rates being so high? Why do I need to take the risk of owning stocks? And that's a great question. It's a fair question. In our investment committee, we're always asking ourselves those types of questions. And but the fact that you're even asking yourself that question tells me that there's a reckoning coming for some of these stocks that are priced for absolute perfection. And I do think we see some declines in those companies probably over the next 12 months.
So Don, you mentioned stocks and bonds and diversified portfolios and starting to think about your asset allocation and how we construct portfolios. And so if I look at the results for both stocks and bonds, they were both negative in 2022. How should investors be thinking about the relationships between what we think of as kind of the critically important asset classes, those stocks or bonds? Do bonds still provide the diversification power that they historically have?
Again, another wonderful question, and one of the things that we're always analyzing. So the way I would encourage our audience to think about the diversification power of bonds is that it is related to interest rates. When rates are really, really low, like they were in 2022, the diversification power of bonds is relatively less. All right. And so I think that's an important point, right? But I also think we got to be careful. Not all bonds are created equal. And I'll come back to that point in a moment. I want to finish this thought that I had on interest rates. Now that interest rates are a lot higher, the diversification power of bonds is likewise a lot higher than it was in 2022. And that's because now that you have, for example, US Treasury bonds trading at 5.5% interest rate, the Federal Reserve, if and when the economy faces challenges again, the Federal Reserve has a lot of dry powder now to deal with the next economic challenge. And if the Fed were to cut interest rates, we would see those bonds go up in price, right? That's the good side of owning bonds when rates go down. And so if the economy is dealing with some challenges, if stock prices continue to go down a bit and the Fed needs to get involved, certainly that is, they have a lot more dry powder now than they did in 2022. So I think the diversification power has improved markedly over the past year and a half. Now, before I move on, I would just highlight that I think it is important to keep in mind that there's more in the world than just stocks and bonds. There's real estate, there's private assets, private equity, venture capital. And so there's a lot more out there that investors could and should be doing to diversify their portfolios. And so again, that's a conversation clients should have with their advisor. Before we move off of this topic, I do think it's important to highlight that not all bonds are created equal. Longer term bonds were hit hardest over the past year and a half. At Mercer Advisors, we invest mostly in very short-term bonds. So the way that you immunize or protect your portfolio on a relative basis from interest rate hikes is you invest in shorter-term, higher quality bonds. And that's what we've done for quite a long time. In January of 2022, when our investment committee met, we voted to shorten the duration in our bond portfolios. We did that again in April of 2022. We did that because the Federal Reserve was telling the whole world that they were going to raise interest rates. And our investment committee, we took them at their word. We said, okay, well, if that's the case, let's shorten up our duration. Now, did we still lose a little bit on our bonds in 22? Yeah, a little bit, but not nearly as much as the bond market. The bond market was down 13% in 2022. I think we were down somewhere in the 4 to 5% range, depending on the portfolio and so on and so forth. So, so there are things you can do. And again, I think it's important to keep in mind, not all bonds are created equal.
Well, building on that and that discussion of yields and the expectation of return and the safety and thinking about bonds and the duration, let's talk about cash. If I look at the bank CDs and money market funds and the yields that they're paying after paying, nothing for many years here in the past, how do you think about, should there be more cash in a portfolio for a client? Should we be investing in CDs or money market funds? What's your outlook there for an overall asset allocation for our clients?
Yeah, I mean, we're all loving these higher yields now, right? Especially for our emergency reserves, for our safety bucket. to use a financial planning term that I used to use many years ago. So look, I mean, these higher interest rates are great. And so I certainly encourage our clients, look, take advantage of those. But I think it's important to draw a distinction between the short-term safety or the emergency reserve assets that you hold on to. Naturally, you can get really nice, attractive interest rates on that cash right now. But I think it's important to keep in mind that interest rates can and do go up and down. And like I showed you on the PowerPoint slide a little bit ago, even the Federal Reserve themselves are forecasting that at some point in the future, we don't know when, but they themselves are forecasting that they're going to cut interest rates. And so I think we need to keep in mind that these are higher interest rates than even the Fed themselves believes is probably sustainable long term. So if those rates go back down, then naturally you're not going to get those higher yields, right? So you need to keep that in mind. If you talk to your advisor, I think all of us as advisors, as certified financial planners would agree that the biggest threat to your financial security, your long-term financial security, especially as you enter retirement, is inflation. It's not the market, it's not interest rates, it's inflation. Inflation will erode your purchasing power over time. The best tried and true approach to outperforming inflation over time is you need those growthier asset classes in your portfolio. That is stocks. You need stocks in your portfolio to outperform inflation over time. If you bought a bond today, a 30-year US Treasury bond today that's paying you 5% annually, that 5% is not inflation adjusted. That will not rise. That will not grow. There's no earnings. When you buy stock in a company over the next 30 years, that company is doing its best to grow. It's looking to expand into new markets, to attract new customers, to deliver more profitable products and services. All of that flows to you, right? If you look at the dividend yield on the S&P 500 index, for the past 30 years, I mean, it's gone up quite handsomely over that particular timeline. You don't get that with fixed income, hence the term fixed. It's a fixed income. And so you do need to invest for growth. I do think that this balance between stocks and bonds is critically important, though, to constantly be revisiting with your advisor. That's a function of your need for safety, for liquidity, for cash flow. It's also a function of your need to grow your assets on an inflation adjusted basis over time. So I would encourage all of our clients, revisit that constantly with your advisor. It's one of the most critically important decisions that you have to make as an investor, is what is the right balance for you of that mix between stocks, bonds, real estate, and cash.
So you mentioned a few other asset classes, and so I'm going to call them the quote unquote alternative asset classes. And so we think of those as being real estate, AI stocks, Bitcoin, and more commonly gold, silver, hard assets. Why or why not should investors own that in your portfolios and your thinking on those?
Wow, this is a big topic. We could spend hours on this one. So first off, I think it's important to acknowledge that there's no magic bullet in financial markets, right? And I think oftentimes these alternative asset classes are positioned as these silver bullets or magic bullet or whatever you want to call it, a panacea.
Or the gold bullet.
Or the gold bullet that's going to fix all of our problems. There is no asset or asset class in the market that gives you safety, that gives you liquidity, that gives you growth, that gives you inflation hedging properties. There's nothing that gives you all that at one time. And anyone who tells you otherwise, you should hold on to your wallet, turn around and run, okay? There is no such thing. And so I think that's an important point to keep in mind. Real estate, AI stocks, I don't view those as alternative asset classes. If you just owning an index fund, you have an allocation to real estate. Real estate was added to the S&P 500 in 2016. So real estate's very much part of the market. So I don't view that as alternative-y. Maybe private real estate, that's certainly an alternative asset class in the sense that it's not publicly traded. But that's a different topic for a different day. AI stocks. Well, what are the AI stocks? It's NVIDIA, it's Microsoft, it's companies like that. You already own those in your portfolio. Just buying an index fund, you already have an allocation to AI stocks, which really gets me to, I think, the most important point, which is there's nothing against owning perhaps a little bit of gold or commodities or something along those lines. It all comes back to the position sizing. Well, how much? The challenge with these conversations is typically I'm asked these questions through some sort of lens as if this is a binary decision. It's all or nothing. All my money is going into AI stocks, or all my money is going into gold, or even a substantial portion of my money going into, say, gold versus a more diversified portfolio. That, I think, is very dangerous thinking, right? If you want to take a 0.5% of your portfolio and buy some gold because it makes you feel good, then fine, do that. I don't see a major problem with that. I think doing something north of that, I think, is problematic. If you look at the long-term history of gold, for example, since you brought up gold, Kara, between 1980 and I think 2003, gold over that whole period, 23 years, delivered negative returns to investors, right? So if you bought gold in January of 1980, you had to wait until 2003 just to break even on your investment from 1980, right? That is an exceptionally long period of time of horrible returns. And think about it. Inflation was positive over that period, which means gold didn't hedge inflation over that 23-year period. Now, gold did phenomenally well in the run-up to the financial crisis, which is why it's even a topic today and why we tend to get questions on it, right? And it's done really well recently. It didn't do so well in the immediate aftermath of the financial crisis for the better part of, what, 8 years maybe, right? So gold, I look at gold as like one of these, it's almost like a lottery ticket in terms of its payoff, meaning that you have these really long periods of chronic losses or even flat returns if you're lucky, and then you'll have a spectacular payoff. We saw some of this last year when the Fed started raising interest rates. So I think we need to be careful. I would argue that's not really an investable asset, right? When you have to go 23 years to break even, that's our view. All right. So I would just caution, back to my initial comment, there's no silver bullet, there's no gold bullet that's going to solve all of these problems that we as investors have to deal with, right? We need safety, we need liquidity, we need growth, and we need inflation hedging. That's how you should be thinking about your portfolio, right? Investing is not some, game to be won. It's not a sport. It's a means to an end. And that's how you should be thinking about your portfolio is my portfolio bringing me closer to achieving these goals, or is it pulling me further away, right? That's how you should be thinking about investing, not necessarily looking for some magical asset class that's going to solve all of our problems.
That's really great insight, Don. I think in terms of how we think about solving for portfolios and what's important for each one of our clients individually as we build their portfolios. But I know we've got a lot of newer clients on this webinar as well. So could you review kind of how do we make investment decisions at Mercer Advisors? Walk us through the investment committee and when, as you mentioned, we do make some changes, kind of how and why we do that.
Yeah, so that's a great question, and we could spend a couple of hours talking about them. I'm always happy to talk about how, talk about Mercer and how we do things. But to this very specific question, so Mercer Advisors has an investment committee, and I'll start with the investment committee, and then I'll explain perhaps the rest of the investment function at Mercer. Our investment committee is 51 people from across the organization. 3/4 of those folks are advisors like yourself, Kara. 1/3 of those members are female. It's a very diverse group, diverse views, which is good. And I'm an academic at heart, and I love when we have our investment committee meetings because there's lots of debate, lots of discussion. And those 51 members serve on 7 different subcommittees that have very specific focuses. So for example, we have a subcommittee just on venture capital and private equity. We have a subcommittee on institutional portfolios, and we have other subcommittees focused on everything from manager selection, so think mutual funds, ETFs, and another committee focused on portfolio design. And so the whole idea there is to get lots of ideas, lots of inputs. We believe at Mercer, and I believe this with every fiber of my being, that no single person has a monopoly on good ideas. And so we want to definitely have that debate. Should always be a data-driven debate and always focused on what we believe to be in clients' absolute best interest. We are fiduciaries. That is critically important. We do not sell financial products. We are a registered investment advisor, and that means that by law, we have a very serious fiduciary duty to our clients. And so the investment committee's mandate is to uphold and deliver on that fiduciary promise that we make to all of our clients. So that's investment committee. Investment committee makes all the portfolio design and manager selection decisions in our portfolios. Working with your advisor ultimately custom tailors that portfolio. They personalize it to account for your preferences, your constraints. Maybe you have capital gains issues, tax issues that you're trying to manage. So your advisor works with you to select the appropriate asset mix, the appropriate portfolio strategy that our investment committee is managing on your behalf. The rest of the organization has close to 80 full-time people just across what we call the investment function. So that's trading, that's portfolio research, portfolio design, portfolio consulting. There's a group of consultants that actually work behind the scenes to support your advisor, right? And I was an advisor for the first 20 years of my career. We don't know everything. We need help, right? We have attorneys, we have CPAs, we have investment experts, we have trust experts to help give us advice, to help us understand what's the best solution for our clients. So it's a very deep organization, a lot of talent, a lot of folks contributing to how we think about the world. We do take a very scientific approach to how we think about portfolio design. Our goal isn't to try to beat the market every 10 minutes or every quarter or even every year. Our goal is to make sure that we are delivering exceptionally well diversified, risk managed portfolios to our clients, and that we are doing that in the lowest cost possible. So that helps our clients hold on to keep the returns that they're earning in their portfolios. So lower costs, more tax efficient, but very scientifically designed. We spend a lot of time, Kara, revisiting the latest academic research, looking at the data, and thinking through what is the absolute best thing to do, given what we know about markets and portfolios. Our goal here is not to invest in fads, right? We're not going to invest in popular trends. Our goals is to help you achieve your goals, and to do that in the most responsible, prudent, low cost, and tax efficient way possible. So that's how we think about those things.
So I've got a couple of questions, Don, about diversification. So we've got questions about what is the benefit of building a globally diversified portfolio? Is it possible to be over diversified? Would you contrast that with investing in maybe just 15 to 20 stocks and picking those? So can you speak to why diversification is important and how we think of it in terms of portfolio construction?
Yeah, it's a great question. So first, let me say it is mathematically impossible to be over-diversified, right? And that's because diversification is a risk management strategy, right? I'm not going to bore our audience with all the financial theory, but anyone who's taken a graduate level course in finance or portfolio management knows that you cannot be over-diversified. That's just mathematically not a thing. So again, diversification is about risk management. It's not about maximizing returns. Those are different things. If you want to try to maximize your return, then there are other things perhaps you could do. But with any attempt to maximize returns, by definition, you are really gearing up the risk in your portfolio. So let me take the example, 15 to 20 stocks. Okay, that is not a diversified portfolio. That is an exceptionally risky portfolio, right, by any measure. And just to give you a case in point, right? I mean, let's just say you own 20 stocks and let's say a handful of those were in technology last year. Last year, technology as a sector was down 40%. Ouch, right? So that's not a good thing. Let's say some of those companies were perhaps in Enron, right? I mean, for those of us who've been around long enough, we know that I can't tell you when the next Enron shoe is going to fall, but there will probably be another one, right? These things happen. Diversification is to protect you against those things happening. Now, there's one other point that I wish to make. If you look at all stocks that have ever been publicly traded since the dawn of humanity, and we actually have that data, right? Going back to 1896 when the Dow Jones was first formulated. And Jeremy Siegel at Wharton actually took this data back to like 1804. I don't know how he did that, but he went all the way back to 1804. If you actually look at all the stocks that have ever been publicly traded, the vast majority of them, close to 100% of them, actually underperformed the stock market. And you may be thinking, well, how could that be? How can the majority underperform the stock market? Well, that's because most stock market returns come from a very, very small handful of companies. About 4 to 5% of stocks account for almost all of the return on the stock market over long periods of time. The problem, the challenge, is identifying those companies in advance. That is exceptionally hard to do. The very, very, very best asset managers in the market have really been unable to do that, right? Maybe one or two, and even then, most of those folks ultimately have failed over time, given enough time. So the challenge is identifying those companies in advance. So what's the best thing to do? Well, the best thing to do is to diversify. Why pick one when you can just pick all of them, right? That way you hedge your bets, right? And that way you can ensure that you're going to capture the broad market return and avoid the risks of perhaps stepping on some sort of Enron-like, or it doesn't have to be Enron. Think of Sears. Sears was the Amazon.com of the 20th century. For those of us who are old enough, the Sears catalog was, that was Amazon.com, right?
Yep.
Sears bankrupt. It's not even around, right? I think that just highlights that the biggest and best companies that you're in love with today that you think are going to be around forever, no, they come and go. There was a time when Apple was dead. Apple has come back to life thanks to Steve Jobs, but there was a time when Apple was virtually dead. So anyway, I think that makes the point. So you definitely want to diversify and not try to load up on just 15 to 20 companies. I would argue that's not a prudent approach to managing money. So I hope nobody does that.
Well, I've heard you say many times, and I think historically it's been proven that time in the market is more important than trying to time the market. But we have questions here about, does buy and hold still work? And if we hear clients say maybe in their portfolios, well, how come there aren't a lot of changes if perhaps they have mutual funds or ETFs in their portfolio? And can you talk a little bit about how we think about making changes in the portfolio, and a bit about what mutual funds, ETFs, and how that works, and seeing the adjustments that are made to portfolios?
So I think I think the quote buy and hold is really over interpreted and taken far too literally, right? I would agree that lower turnover portfolios, meaning you're not constantly buying and selling and playing the hokey pokey with the market where you're in, you're out, you're in, you're out. That's not investing. You definitely want to minimize that. One, because there are transaction charges, right? When you buy and sell, even if your custodian tells you it's free, it ain't free, right? There are costs somewhere along that supply chain that ultimately we as investors are paying. It could be in the form of spreads, it could be a commission, could be a lot of different things, right? So transaction costs are not free, which means you want to minimize that, right? You don't want to overly trade. At the same time, this whole idea of buy and hold, I think, is taken too literally. Even an index-based portfolio, which would be the epitome, think of Vanguard, which would be the epitome of a buy and hold strategy. Even their index funds will have turnover of, say, 5% annually. That's because the S&P 500 reconstitutes every year. They kick out some companies and they bring in new ones. If you look at an ETF portfolio here at Mercer Advisors, think of like our multi-factor global equity portfolio. Even if you look at that, and let's say it owns all ETFs, right? And at Mercer, we use ETFs, we use individual stocks, we use individual bonds, we use mutual funds. It just depends on the situation. But if you look at an ETF portfolio, you optically, as the investor, maybe you're getting your statement and you're like, hey, there's no changes in the portfolio. Well, let's back up for a moment. There actually are a lot of changes. You don't see it, but if you look under the hood inside each of those ETFs and you look at the portfolio as a whole, you're going to see probably about 20% average turnover. So what does that mean? Well, if you own 10,000 companies through a basket of ETFs, which is very common, if you own 10,000 global companies with 20% turnover, right? Think about that. That's 4,000 trades, right? Because you sell 2,000, you buy 2,000. That's a lot of transactions. You don't want to see those individual trades in your account. Why do you not want to see that? Well, it's more tax efficient for it to occur inside the ETF. ETFs have some special tax privileges that you and I, as individual investors buying individual stocks, We don't enjoy those tax privileges, right? That doesn't mean that you couldn't or shouldn't build a portfolio of individual stocks. I'm raising this so that we understand it. That's a very important consideration. So there's very much turnover, things constantly changing in the portfolio. If you look at a value strategy, if you look at a lot of our portfolios, you'll see an allocation to value stocks. Could be a DFA value fund, could be an ETF or something along those lines. If you look at DFA, for example, every day they are reconstituting the portfolio. They're selling some, buying others. And that's because the prices of companies are always changing relative to their earnings, right? Or relative to some other accounting metric that we use. So there's constantly trading that's occurring, even if clients don't always see that. It's occurring inside of the ETF. Now, you asked about, well, when does our investment committee make decisions? Well, let's just go back to 2022. In January of 2022, our investment committee had voted to shorten duration. Remember, I said a little while ago, the Fed, beginning in October, October of 2021, the Fed started telling the whole world, hey, we're going to raise interest rates come March. And so our investment committee, our view was, well, let's take them at their word. Inflation is really high. It was getting higher. And the Fed says they're going to raise interest rates. Seems logical. At the time, our portfolios had a duration of about 6 years. And remember what I said earlier, the way that you protect your bond portfolio against rises in interest rates is you want to shorten that up. We originally shortened that up to around 4 years in January 2022. Fed raises rates in March of 22. And it was actually in April, mid-April, that the Fed said, okay, we are not going to be raising rates only at a quarter point. We're thinking 3/4 of a point, maybe even a full point going forward. That was a shocking moment. We held an emergency investment committee meeting. We said we need to do something about this. And we shortened up duration even more. So even though we have a large committee, I like to think that we're very agile, we're flexible, we're definitely not afraid to make changes. And we did that. We also had, I think this was earlier this year, Kara, we had 2 managers in our portfolio. I won't mention their names, but we had 2 ETFs in our portfolio that our investment committee was not happy with some of the changes they had made in how they were managing that portfolio. We sold. That was $500 million worth of trades that we placed in April and again in June to exit those positions. So we're certainly not afraid to make decisions. We are data dependent. I know that term's a bit overused, but we look at the data. We look at what the Fed is telling us. And if we think a change is warranted, if it's justified, if it's defensible, if it's in our clients' best interests, then we're going to make that change.
Well, Don, this last question that I'm going to ask you kind of stuck out, and it's actually a personal question.
Uh-oh.
Our audience would like to know what you do for fun.
I don't have fun. No, I'm joking. I'm joking. I went to University of Chicago, and they used to say University of Chicago was where fun goes to die. In fact, they actually have t-shirts that say that, and I believe that. No, what do I do for fun? All kidding aside, I love sports. I love college football. I love baseball. I usually love my Phillies, but I don't love them too much right now. I'm a big sports fan. I'm also a big science fiction geek. If you actually look on my shelf back here, I've got Baby Yoda. I've got, these are all little bobbleheads. I have Darth Vader, and even have Indiana Jones up there. So, and Boba Fett. So we love movies and science fiction, and I love reading and all those things, and just love going for long walks in the woods. We have a farm outside of town where I like to just go for a walk, and you just stare up at the trees, especially this time of the year. So yeah, sports, the outdoors, science fiction, those are kind of my big 3.
I'm away from the office to get a wider perspective. I think that's really helpful.
That is true. So,
well, thanks for all the commentary. I'm seeing a lot of questions as well asking about if this presentation is being recorded. So the answer to that is yes, this presentation is being recorded, and we will be posting it, as we do with all of our capital market updates, to our website, merceradvisors.com. If you go to our insights section, you'll see that all of those are posted. In addition to these updates that we do on a periodic basis, you'll also find a lot of Don's commentary on certain happenings in the market, and as things change, those also get posted on our Insights tab. Additionally, you can find information about lots of things that we reference that we aren't able to cover in detail with the time limitations. We do cover on our podcasts, in much more detail. So again, you can find those on our website at merceradvisors.com. So as we're coming now here on to time, Dawn, thank you for all of the insight that you share with all of us and our clients. And thank you to all of our clients for attending, for providing these great questions. If we didn't have the opportunity to get to your question, as we mentioned, we have been recording those and we will be sharing those with your advisor, and they will be able to answer those questions as well for you. Thank you all for attending. Thank you, Dawn.
Great. Thank you, everybody. Thank you, Kara.
Take care.